You converted your IRA to a Roth, you paid the tax bill, so that money is yours, right? Not so fast, my friend. If you are under 59 and a half, one little known rule can still hand you a 10% penalty. We'll talk about that today on the Howdy Neighbor Retirement Show.
It's the Howdy Neighbor Retirement Show.
Howdy, neighbor. I'm Michael Andrews with Andrews Insurance and Advisory, and you are listening to the Howdy Neighbor Retirement Show, where we tackle real-life questions about retirement, Medicare, and Social Security every week. Today is another full-blown Michael tutorial, and we're going to dig into something that does not get talked about nearly enough. That is the 5-year rule that applies specifically to converted Roth IRA funds. So if you've been listening to this show for a while, you know I talk about Roth conversions a lot, and with good reason. Tax rates are at historically low levels right now, and those of you sitting on large IRA balances have a real opportunity to do some proactive planning before that window closes. But Roth conversions come with rules, and one of those rules is misunderstood even by people who think they already know how Roth IRAs work. So today I want to walk through 5 things every person doing a Roth conversion needs to understand about this particular rule. The first thing to know is this: when you do a Roth conversion, you pay the taxes on that money up front. You get a tax bill in the year of the conversion, and you take care of it. And because of that, those converted dollars are always going to come back out of your Roth IRA tax-free. There's no 5-year rule around the taxation of converted funds. That part is pretty straightforward. But the 5-year rule we are talking about today is not about taxes. It is about the 10% early distribution penalty, and those two things are not the same. That brings us to the second one, and that is if you are under age 59 and a half and you pull money out of your Roth IRA that came from a conversion, and you have not held those converted funds for at least 5 years, you could owe a 10% penalty on that withdrawal. Not income taxes that you've already paid, but the 10% early distribution penalty can still apply. Now, there are certain exceptions that can waive the penalties, things like disability or certain higher education expenses. But outside of those, if the 5-year clock has not run on your converted funds and you are under 59 and a half, that penalty is very real. The third thing is where it gets a little more nuanced. I want you to pay attention here because each Roth conversion you do has its own separate 5-year holding period. They do not all roll together into one clock. If you did a conversion in 2024 and then you did another one in 2026, those are 2 separate clocks within the 2 separate starting points. And here's a small but important detail. That clock does not start on the actual date that you did the conversion. It starts on January 1st of the year that the conversion was done. So if you converted any time during 2026, whether that was in January or all the way at the very end of the year in December, your 5-year clock for that conversion began on January 1st, 2026. That means it might not be 5 full calendar years from the date that you converted those funds. The fourth thing that I want to cover is why this rule exists in the first place, because I think it actually helps you understand how it works. When Roth IRAs first became available, people started looking for loopholes. And somebody figured out that if you converted your traditional IRA to a Roth IRA, well, that distribution was taxable, but it was not subject to the 10% early withdrawal penalty. So the idea from there was pretty simple. Why don't we just take money out of our traditional IRAs, run it through a Roth conversion to dodge the penalty, and then turn right around and pull it out of the Roth the next day? The government quickly caught on to that little trick, and then they shut it down. So the 5-year rule on converted funds is essentially Congress saying, listen, you cannot use a Roth conversion as a backdoor way around the early withdrawal penalty. If you would have owed a penalty pulling that money out of your traditional IRA, you cannot get out of it just by converting first. And the fifth thing I want to make sure is absolutely clear, because this is where people can get tangled up. There are actually 2 completely separate 5-year rules that apply to Roth IRAs. One is the one that we've been talking about today, and that is the conversion rule. It restarts with every new conversion. and it only applies if you are under 59 and a half, and is specifically about the 10% penalty and not about taxes. But there is a second 5-year rule, and I call it the forever 5-year rule. This one is about whether the earnings inside your Roth IRA come out tax-free. The forever rule starts with your very first Roth IRA contribution or conversion, the first one that you ever do, and it never restarts no matter how many future contributions or conversions that you make. Once you've cleared that initial 5-year period, the earnings question is answered for good. So these two rules work very differently, and knowing which one you are dealing with matters a lot. Now, here's the good news for a lot of people listening to this show. If you are already over 59 and a half and your Roth IRA has been open for at least 5 years, neither one of these rules is really a concern for you. Your distributions are going to come out tax-free and penalty-free. But if you are younger, or if there is any chance you might need to access these converted funds before 5 years had passed, this is a conversation worth having before you make any moves, because nobody wants to find out about a 10% penalty after the fact. So let me wrap up today's episode. Converted Roth funds are always tax-free when you take them out. You've already paid taxes when you converted, but the tax-free and penalty-free are not the same thing. If you're under 59 and a half and you pull converted funds out before the 5-year holding period is satisfied, the 10% early distribution penalty can still apply. Each conversion has its own clock. The clock starts January 1st of the year that you convert, and do not confuse this rule with the separate forever 5-year rule on earnings, because those two rules are completely different animals. So if you got a question you'd like for me to tackle on the show, shoot me an email at michael@andrewsadv.com. I read every one of them. I just might answer yours on a future episode. You've worked hard to build your retirement, and you don't have to make these decisions alone. If you want a second opinion on your retirement plan, I am here to help. It doesn't cost anything for me to take a look, but not letting me, man, it could cost you thousands, or at least a couple extra 10% withdrawal penalties from your Roth. So if you're ready to take this to the next level, call or text me at 918-842-7379, or schedule a time on my calendar at andrewsadv.com. And wherever you're listening, whether that's radio, YouTube, or Facebook, make sure you subscribe and follow the Howdy Neighbor Retirement Show so you don't miss next week's episode. If this helped, give it a like, share it with a friend who could use some good neighborly retirement advice. Thanks again for listening, and we will see you next week right here on the Howdy Neighbor Retirement Show. Thanks.
It's the Howdy Neighbor Retirement Show, helping you plan so your money will grow.